Today, I want to share with you a video we're calling How I Trade Options with Just $1,000. Now, listen, if you have a small account, I understand how difficult it can be to trade anything, right? And if you're looking to trade options, there's all kinds of different ways to trade options with account balances less than $1,000. So we're going to go into great detail on that today. I'll give you my real world perspective, and we're going to also talk about the theory behind a lot of these options trades. So let's watch this together. And this is how I trade options with just $1,000 with real examples inside.
Many traders believe that if they don't have a large option trading account, they actually can't trade options. That's actually not true. In fact, the opposite is the case. You can actually trade options with an account as small as $1,000. In this video, I'm going to share with you 4 strategies I use in my small option trading account. My name is Randy Perez. I'm a 20+ year stock and option trader. I'm excited to share with you these 4 strategies I use in my small option trading account. As always on this channel.
Okay. One thing that I want to talk about is the options chain, right? And we're going to use SoFi today as an example. SoFi Bros for life. Now, there's all kinds of options trades that you can make right here on SoFi without doing anything fancy. Just long calls, long puts. Lots of options and lots of choices that are under $1,000. Okay. Now, what I also want to do is talk about how using the 80 delta, which was a question that was brought up to me, and I'm definitely going to add into that. Using the 80 delta options is actually significantly less expensive than further out of the money options or even closer at the money options. So let's talk about why that is real quick, and we will continue on with the video. But where I live is the 80 delta, right? Now, I would go with this one right here if I were looking to trade SoFi long. I'm not making the recommendation to do so. But this has a 78 delta right here, and it's approximately $3.60. All right. So the option delta is 78, and the extrinsic, intrinsic, and we're going to use the ask price and current price of SoFi is $30.95. Now, what's cool is math always works. Now, the current price of SoFi is $30.95. Okay. And we're looking at which strike is this? The 28 strike. The 28 strike. And let's do strike here. 28 strike. Okay. So we can calculate very quickly the extrinsic and intrinsic value based on the ask price. So the ask price is $360. That's what you're going to have to pay to get into this option. That's well less than $1,000 outright, right? We can see that right ahead, right? That's $360 for a 1 contract. You could almost do 4 contracts on that. In fact, what would this be by 3? That's just over 1,000 at 3, so 1,080. Okay, but we're just going to stick with 1 contract for this. The extrinsic value and intrinsic value are calculated like this: you take the current price, $30.95, minus your strike price, get you your intrinsic value. This is the moneyness. And that happens to be this exact number right here. Oh my gosh, I might know what I'm doing. The intrinsic value is the moneyness of the option. This is your investment in the option. Think of it that way. Anything out here has no intrinsic value whatsoever. Anything in the money does have intrinsic value, and it goes up by the amount of the difference between the strike price and the current price right here. Okay. As it goes up, it gets deeper in the money. You get more intrinsic value. At the end of the day, we're trying to maximize intrinsic value. Anybody who's buying out of the money options, they want it to go in the money so you get the intrinsic value. Now, for me, this is something I learned from a billion-dollar hedge fund manager named Larry Hite, one of the original market wizards. If you start here, you've already got an investment that is worth holding. Right? You've already got a huge portion of this option with moneyness associated with it, but you can't buy it for that. You can't buy it for that. FYI, moneyness equals value. Yes. Because of that, the actual price here, $30.95, minus the intrinsic price is going to get you, I'm sorry, I think I messed that up. The ask price, there we go, minus the intrinsic value. So the price of the option minus the intrinsic value that we already calculated is the extrinsic value, which happens to be right there. Now it's rounding a little bit because it's between the 45 and the 60, get you 65 cents, right? So if we add these two up, this totals to $3.60, okay, which is less than $1,000 to start with. And then how much is the extrinsic value? The extrinsic value on this option is 18% of the total ask price. So 18% of this will decline over time. It is just a fact. And if you want to trade options, it will happen that way. You can't get around this. Okay. Now we're going to do the same exercise here. And instead of the 78 delta, we're going to go with the 57 delta. Okay. That's the 30.5 strike. And you'll see where I'm going with this in just a moment. So the ask price is 196. Okay. So it costs less. I agree. And so this is working on Richard's question earlier. If you thought a stock was going to go up, why pay for the 80 delta? Why not go with the cheaper delta? And I'm trying to explain this why. Okay. So instead of buying, 3 of those, you could buy potentially 5 of those for your $5 or your $1,000 account balance, right? And we'll talk about that just more in a minute. Your intrinsic value is still the same formula. This current price minus your strike price. Strike price here is 30.50. Okay. So your intrinsic value is 45 cents. Same one right there, right? Now your extrinsic value, same formula, equals the ask price minus your intrinsic value, and that's $1.51. Now you'll notice right here, 18% of this will decline over time. 77% of this will decline over time. This one costs less dollar-wise, but the moneyness of it, the value of it, is like 4 times less, 5 times less. What is that? Equals this divided by this. Oh, I did it backwards. Equals this divided by this. 6.5 times less. 6.5 times less value in the option itself. And how much more will decline over time? 2.3, right? So basically the cost of this option, the actual cost outlay, because this will decline over time, this is your investment, is significantly higher. Even though the actual outlay here is less, this is a larger amount that will decline over time. 77% of your option value will decline. 18% of mine will decline. So here in this case, while it does cost less, your cost per delta goes way down. It goes way against you because of how much extrinsic value, how much it will decrease by. So I just want to lead off with that example here because you don't have to get fancy, right? But it does matter. This is a $30 stock. And if we go to QQQ, this is not a $30 stock. This is a $600 ETF. You can call it $600 stock. And it's going to cost significantly more at the 80 delta. It is a fact. $34 instead of $3, which is actually less than I would expect. It's about 10 times as much, not 20 times as much, even though the price of the stock is 20 times more. So where I'm going with that is you don't have to get fancy. You don't have to get fancy at all. But Goody had some great questions, and we'll talk about those more as we get through this.
I use my real life trades. I don't make some up. I show you the good and the bad. To me, that's an important part of trading. You have to know how to deal with trades when they go against you. But first, let's start with a trade that went our way in my small account. Here you see that on October 17th, we sold the IWM Bullish put credit spread. We sold the 208 put and bought the 206 put for protection. Now for that, we received a net credit of 32 cents per share. This is the first option trading strategy I use in my small account, and I use it a lot. That's a bullish put credit spread. You simply...
This is a shit trade. No offense, but this is a terrible trade. This is a no good, very bad, horrible trade. In fact, we're not going to go down any more of this video because if this is where it's going on the very first, it's only going to get worse from here. Why? Well, because first off, it breaks the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. Now, I understand selling options is sexy. It's so sexy. It can move up, it can move down, it can move sideways, and you're still going to profit. Sounds great. And it happened to me where I had an 84% win rate and still was losing money. And of course, this is covered in Outlier University. Did somebody say Outlier University? Let me see if I find the button. There we go.
Are you ready? Let's go!
Respect is earned. Respect is never given.
That's right, Outlier University. We are going live Tuesdays and Thursdays for members of Outlier, where I'm teaching them literally everything that I know. Now, you can get access to Outlier for just 82 cents a day, and all of the replays of this will be on YouTube permanently forever for free. So we're not keeping anything from you. If you want to learn everything that I've ever learned in trading, it will be done for free. And in fact, the first replay of that comes out right after this video finishes. And Shane is one of our Bravo students. So Shane was in class yesterday learning, and he's going to change his, basically he's going to change everything in his life because of this. And this was absolutely by far the fastest rage quit I've done. I have rage quit this video. We are 56 seconds into the video and I have rage quit. Why would I rage quit this one? Well, let's do some maths here, okay? A 32-cent credit, 32 whole cents in credit means that the very maximum he can win on this trade is 32 bucks. $32 maximum win on this trade. Wow, what an incredible gain. He can't make more than that. It is capped. Let me show what I mean. Short put spread. He cannot make more than that because in this example, open image and new tab, it's capped. It's $32. $32 smackaroons. Wow, what an amazing trade. Now, let's look at the other half of it. This is $2 wide. So what that means is that the max risk in the trade is $2. And then you subtract the 32 cents from that to give you $1.68, which means his risk in the trade is 168. Okay. Now, what is 32? 168. What is 32 divided by 168? 19%. So in theory, he could make 19%. That's not so bad. It's not so bad. But let's say that it doesn't work out. Let's say that it goes wrong. He can lose 5 times as much as he could possibly make in this trade. Meaning if he gets it wrong, he now needs 5 perfect trades in a row to make up for 1 losing trade, which is why we have got to understand the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. And you certainly don't want to be 5 times the maximum that you could possibly make in a trade going against you once. 1 bad trade now takes 5 to make up. This is how I had an 84% win rate and continued to lose money. Okay, so the sexiness of this, and I get it, is that let's say this is the current price, this is your break even, and this is, you know, any upside, right? And Terry's got a great point. Why would you hamstring your own trade as soon as you make it? Yeah, imagine if IWM in this trade, it actually like blows up, right? He caught it at the very perfect time. Bro is stuck with $32. I hope you enjoy those $32. So instead of having a 19% gain, which he's going to be super stoked about his 19% gain, he could have had 190% gain on his options. Crazy. Carol says, I am never selling options. Yeah, nobody should ever sell options. But the thought behind it, and I get it, is this is a small trade. It is a small trade. It's a $168 in capital trade. Big whoop. Big whoop. Let's also, let me see if he's got his deltas on here. No, he doesn't. But let's try and build something similar to that. All right, we're going to go to IWM. And once you see the deltas, you'll be like, oh, okay, this is stupid. Oh, okay, this is dumb. Let's go to, he doesn't have deltas on here, so it's hard to tell. What's IWM stock price? 1017.24. IWM. 1017 of 24. Okay, 1017 is this date here. Let's say, for example, 226.54. Okay, we can kind of work with this. 226.64 was the price that time, 226.64. And then he's saying that he sold at 206. No, sold to open the 208. Okay, so 208 equals this minus 208 gives me $18 away. So let's replicate this. So we're going to go $18 out of the money. So 244 minus 18. I don't want to get it wrong, so I'm going to double check myself. 226. Okay. 226. Look at this. We're actually going to like mimic this trade as best we can. $2 wide, 226, 224. That's going to give us a credit of 9 cents. Okay. So 9 cents of credit. That's a great trade. Let me tell you. Maybe he went further out in time. Let's say he went to like, let's say he went for this one here. Still, what was that? 226, 26, $2 wide. That's 29 cents in credit. What did he say? His 32. Okay, this is close. We can get close here. I'm gonna drop chat off for a couple minutes here. So this is 29 cents in credit, similar to his 32 cents. So we'll roll with that. All right. So looking at this, so his total delta is $1.90. Give me a freaking break. $1.95. Now, I understand the thought behind this is to make a small trade, but this is dumb. $1.95 in delta means that for every $1 that IWM moves, and this is a $200 stock, so it's going to move more than $1 every once in a while, you're going to make $2. Not $2 on the total price of the stock. For every $1 change in the underlying stock, your options trade will make 2 entire bucks. That's just a terrible trade. Why would you want that? Now, of course, where I like to live, as I mentioned earlier, is in the 80 deltas. Now, this is $24.95. That costs a lot more. I agree. So the way that we can try to get this less expensive is you can go closer in duration. Let's start with like 23 days. 80 delta gets us $15. That's not 1,000 yet. Let's go a little bit closer. Let's try 13 days. And 80 delta, not a lot of liquidity here though. Look at that. We now have an 80 delta trade for under $10. For under $10. Now, like I say, not a lot of liquidity here, so disregard that. But now we have a trade that has an 80 delta, and 80 is a lot more than 2. I think it's like 40 times more than 2. So by just a couple tweaks, we've now got a trade that is 40 times. Let me repeat this. Just a couple tweaks. We still hit our goal of being under 1,000. And we have a trade that is 40 times more profitable, in theory, for every $1 move. That definitely fits with the song. Why did I sell those options for pennies today? Yeah, this trade is 40 times more profitable by just making a couple tweaks. And instead of selling a put spread, you go deep in the money, you go long calls. And even though you don't know if the market is going to go up, right? Nobody other than Nancy Pelosi can predict that. You still can ride a bullish trend. You can ride a bullish trade. That was the whole point of a put spread. A put spread is a bullish trade, right? Your goal here is for the stock to stay up, not for it to go down. And on that date, it was definitely trending up. Now let's look at the gains he could have left behind. All right, let's look at the gains he could have left behind. Now, granted, I understand it went down, but we're going to go for like theoretical maximum burn right here. $17. We're going to go for maximum burn on this trade. Y'all ready? And if you're ready for the maximum burn, type burn in the chat because it's gonna be great. Okay. So remember, his max gain is 32 whole dollars. That's it. So if IWM goes from 226 up to, because it did. Now, granted, I understand it went down, but we're going to inflict maximum pain here. And it goes up to 241. That's a $15 gain. Okay, a $15 gain. So if my long call that I bought, and let's say it was roughly, let's call it $9. Let's call it $9. And then it goes up 15, right? We don't get all of that. We get roughly 80. So this times 0.8. Okay, that's $12, which means that my gain is 133%. The gain of taking a long, deep in the money option versus a short put is the difference between gaining 19%, right? He didn't lose. He did not lose, and I'm not saying he did. 19% versus 133%. Right? What is how much more percent is that? Equals this divided by this. That comes to, it's only 7 times more profitable. 7 times more profitable. And if the goal is under $1,000, you can get there, right? You don't have to do these exotic spreads, right? You don't have to do anything like that. Now, I know it went down a little bit before it came back up. He didn't know that. He didn't know that. In fact, let's add maximum damage. Let's add maximum damage. Let's add maximum damage to this trade, right? Let's see, December 20. Is that the expiration here? No, it wasn't. But let's just say, for example, that he had a trade that was, I don't know, going to expire on November 5th. Okay, maximum damage type trade. Wait, December 20. Oh, it still may have happened. Oh, hang on. Oh, 206, 208. I was going to say, if it went under 206 and 208, not only would he be losing, but he'd be losing that 5 times greater. It didn't actually happen, so don't worry about it. Rose still came away as a big winner of 32 entire bucks on that trade. Outstanding work. Outstanding work. Whereas outliers like you and me, we'd be up 7 times more than that, up 133% by following just a couple simple changes. Now, let's go back to this question here from Goody. How do you use ATR in the 80 delta here? So let's set this up. And again, I understand that it went down, but hear me out. Let's say that we held it from here to here. Let's say, for example, that we held it from here to here. Okay. And let's say that we bought it here and it came down and then it came right back up like it did. Now the ATR value, I'll pop you guys off and myself off for a moment here. The ATR is down at the bottom down here. This is called your average true range. Your average true range shows you the volatility of any stock. Now the volatility can be up or down. As you can see here, volatility spiked as price went up on IWM. Volatility was around $2 and then it spiked up to 582. So basically more than, it came around double. Volatility doubled during this period right here. But at the time, it was around 354. So the way that I would do this is I'm looking at the trade and I open my trade here. And then I go for every $3.54 up. This may not be the best example because it gapped a lot, but I'm going to do my best here. For every $3.54 up it goes, I would add my rolling point on. So let's just do the maths. And we say 226.7 plus 3.54, 230.24, 230.24. Now it gapped through that point, which is great if you're holding it. And let's do it again. 233.78. 233.78. And then again, 237.32. 237.32. I mean, by the close from here to here, that was a 1, 2, 3, a 3 ATR move. That is a huge move. I don't know what happened on that day, but goodness gravy. Maybe that was the election. Actually, I think it was. That was November 5th to November 6th. That was the election. A 3 ATR move here. Now, if it had chugged its way all the way up, right? You could have rolled it once, rolled it twice, rolled it a third time. Now, what does that mean? So to Goody's question here, how do you use ATR? This is one of the ways to do it, and the 80 delta. So, we bought the option for $9. Now, let's say that it's moved up 1 ATR. We would look to roll it. So the way you do that is you would sell to close the original trade and go closer to the money. Now, that's up to you where you go. If you start at the 80 delta, you might go to the 70, you might go to the 75, whatever, right? The goal here is just to do it for a credit. If you do it for a credit, then you are in the right path. If you don't do it for a credit, if you do it for a debit, you've done it wrong. Okay. If you build out this trade and it comes out as a debit, you have done it wrong. Stop what you're doing and redo it. So you would sell to close the original 238 and buy to open. In this case, let's just go with the 240, and you would take in a credit of $1.53. Now, what's cool about this is, let's say that you did that 3 times, right? So our original $9 trade, $9. And then we just took in a credit of 153. Okay. Now we've done that 3 times. First roll, second roll, third roll. Right. You're going to have to do a little bit of imagination here, where imagine it chugged its way up and didn't just gap up the whole way. You could have rolled it 3 times. So 1, 2, 3. Now your total risk in the trade equals sum of all 3 of these. So you paid $900 to get into it. You've taken partial profits 1, 2, 3 times. So your total risk in the trade is now 441, which means your total risk in the trade is about half of what your total risk was when you started. How cool is that? Now, what can you do with this? You can trade with it. That's more capital you could go out and do anything you want with. You can take it out, go to Costco, buy whatever you want with it, because that's your money. You've taken that money out of the market with partial profits. Do whatever you want with it. And you're still keeping the trade alive, because once you're down to your third roll, you're still sitting around the 80 delta, because it has moved up so much. It has moved so much that what used to be your 80 delta is probably somewhere around here, the 92. And you've just basically rolled down from 90 to 80, 90 to 80, 90 to 80, like that, 3 times over. So you're still sitting on the same trade concept that you originally started with, which was the 80 delta. How cool is that? How cool is that? Type ninja in the chat if you grasp this, because I know a lot of you guys understand how this is straight up ninja voodoo. Who's outlier voodoo? Yeah, this is straight up ninja voodoo. It is one of the coolest things ever. And the 80 delta goes up as price increases. Yeah, so it goes from 80 to 90. And that's why I say it goes from 80 to 90, 80 to 90, 80 to 90. Now, what's really interesting about that is if you held the original one and it goes up from 80 to 90, it's probably just going to go from like 90 to 92 or 93 or 94, because you no longer get that gamma expansion, because gamma shrinks the deeper in the money that you get, right? Because this has what's called an asymptotic curve. An asymptotic curve here, right? So if this is 100 deltas and this is 0 deltas, it's going to go up, and then at some point it's going to stop going up and have diminishing returns, but it's never going to actually cross 100. So you're basically moving from here to here, back and forth. Your trade goes up. Cool. That was awesome. Now let me put it back down to 80. It goes up to 90. Cool. Let me put it back down, go to 80 again. Trade goes up to 90. Cool. Let me put it back down and go to 80 again. So you get the gamma expansion. You get that gamma expansion, which means the trade works for you more than if you just held it and it goes from like 90 to 91 to 92 to 93. You just went from 80 to 90 3 times over. Pretty cool, right? Pretty cool, right? So I believe I covered that. Your ATR rollups would, I mean, it's really simple. It's just, you know, any chart that you can get the ATR value down at the bottom, you just add it onto your chart. At least that's how I do it. It's a great question. I love these questions. I can deep dive on this all day. How do I feel about a poor man's cover call? First, goody, stop with the super chats. Seriously, I'm not trying to, like, you know, be coy about it. I don't want you to send super chats. The poor man's cover call, I honestly, if it's not a long call and it's not a long put, if you're ready to go short, I'm not interested. Right? I've tried all the strategies. I've tried every combination of calls and puts you can think of. But at the end of the day, the best bang for your buck comes down to deep in the money calls, because you're paying as little as possible in extrinsic, but you're getting the most delta you can associated with that. And then if it goes up, you just roll it back down, and you roll it back down, and you roll it back down. And then eventually you've rolled so many times that there is no more risk in the trade, and you have a completely risk-free trading. You've guaranteed profits even higher as it continues to go up. So that's my opinion. If it's not a deep in the money long call, if I'm going long, then I'm just not interested. Just not interested. And then Trump tweets. And then the golden toilet comes out. I mean, in theory, if you want to think about it, we're kind of scalping scalping gamma by doing that. We're taking advantage of that gamma expansion over and over and over. Or really, I should say, we're not taking advantage of gamma expansion. We are removing the gamma contraction. There you go. Removing the gamma contraction. Okay, so in theory, let's wrap this up nicely. If you are looking to trade on a account with, let's say, $1,000 cap, rather than trying to spread your way into trades and having just baby deltas, I would first go with smaller price stocks. When you have smaller, lower price stocks, you're going to have the ability to buy the deep in the money calls for a lower outright cost. Then when you're on the options chain, going for the deep in the money outright, deep in the money calls, they will cost more out of your bank account, but you are spending less on the part of the option that decreases in value, right? The intrinsic value is what you're trying to maximize. The extrinsic value is what you're trying to minimize and eliminate. And deep in the money long calls allow you to do that. And of course, you know, it's going to be difficult to position size correctly, right? If you have $1,000 account and you have one options trade, like in our example here, and it's $900, and that one doesn't work out, and that one just happens to not work out, it's going to be a huge portion of risk on your portfolio, right? So you've got to figure out what the position sizing is right for you. I can't tell you what that is, but generally the rule of thumb is you want to risk less than 5% of your account. So if you have $1,000 account, you want to risk less than $50. Now, I know that sounds crazy. How am I going to risk less than $50? Right? Let's see if we can do the math on this real quick. So if we we have a $9 option, right? And we only want to risk $50. So it can only go down to 80 cents or $8.50, right? Of course. And we have 80 delta times 0.8, 72. Okay. So your stock has to stay, could only go down 72 cents. And then you would be out those $50, right? Now that's not a lot of wiggle room on a $200 stock. That's not a lot of wiggle room at all on a $200 stock. So because of that, you want to trade smaller price stocks, but understand that until you can build up a big enough position, I would say roughly $20,000 or so is when you can actually start position sizing appropriately. Until you've built up to that point, the wins are going to feel a lot bigger and the losses are also going to feel a lot bigger. And the only way to get around that, honestly, and I know it sounds crazy and it's just the truth, the only way to get around that is to have more capital in place so that each individual trade has less of a overall cumulative impact to you. Does that make sense? Now, Philip has a great question. When you refer to 5% risk, would it be the total net value of the person or the individual account? I would say it's the individual account, right? Because, like, let's say you've got $1 million, you know, of what is it called? Not net value, your net worth. There you go. Let's say you got $1 million net worth. yet you've only got $1,000 to trade with because you've got other things in your life going on, right? Of course, it's not going to be 5% of your total net worth. No. It's just whatever's in that bank account. Whatever's in that bank account. And to skinny buff guy, that point there, right? You could just buy the stock. Now, for every one stock, where every one share is one delta. Always remember that. For every share of stock is one delta. That's why option prices go up to 100 deltas and not above, because they are on 100 shares of stock. I don't know if anybody's ever made that connection, but that's why it goes from 0 to 100 and not greater than 100, is because it's limited by 100 shares of stock. So anyway, I hope that helps. If this was helpful to you, do me a favor, share this with someone you know. And if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day.